Cash equivalents are listed on your balance sheet as an asset right below cash, because cash is the most liquid investment that we have. It is cash. A liquidity is the idea of how quickly something can be turned into cash. So the next most liquid asset that a company can have is what's called a cash equivalent. Now, when we're thinking about cash and cash equivalents and other types of financial instruments, a couple of things that we have to think about and consider is what are the interest rates that we get on those different types of financial instruments? What is the risk profile of that financial instrument? You know, holding the stock of a really small startup company is a lot more risky than, say, holding a bond of the US government, which is pretty secure. We're pretty sure the government's going to be able to pay its debts over the long term. A small startup company, maybe not so much. So there's the rate of return on the interest, there's the risk profile, and then there's also inflation. Now, as a company is trying to make decisions between how much they're going to hold in cash, how much they're going to have in cash and equivalents, or cash equivalents, how much they're going to have in other investments, they have to weigh all of these three different things. So why would you hold cash? Well, you'd hold cash because you need it right away to be able to pay off expenses. You got payroll you need to meet, you got inventory you need to buy, you've got real short-term expenses coming up that you need to pay for immediately. That's why you would have cash. Now, the downside with cash is that it generates zero interest. And if you have a high level of inflation, the value of that cash is going down all the time. So you might be thinking, well, I don't want to have cash itself. What's the next best thing? What's the next best thing that I can turn into cash pretty quickly if I need it, but is still going to be able to maybe generate a small return and have a relatively low risk profile so that I'm certain I can get it back, fairly certain that I can get it back? Well, that's where cash equivalents come in. So a cash equivalent is any financial instrument that can be converted into cash within 90 days, and it has a relatively low risk profile. So you could go buy, like I said, a stock for a small startup company, and you could sell that stock and get it back, get cash back for it in 90 days. But we really have no idea what the price of that stock is going to be. It could go way up, it could go way down, it could go to zero. You could lose all of your investment. So that type of financial instrument is too risky or too volatile to be considered a cash equivalent. So cash equivalents are things like treasury bonds, like I mentioned earlier for the government, but only those that can be converted to cash within 90 days. If it's a 10-year bond, that wouldn't be a cash equivalent. That would be what's called a long-term investment, which is a discussion for another day. But something of that level of risk would be considered a cash equivalent. So certificate of deposits with banks, other low-risk financial instruments like that are considered cash equivalents. Now, the return you're going to get on a cash equivalent is pretty low in terms of interest, but it's better than cash. So again, if you're thinking, oh, I might need the cash in the short term, but I don't want the value of that to be completely eaten away by inflation, I'd put some of my capital, some of my cash in cash equivalents.